Financial Survival Network, helping you survive and thrive in the new economy. Go to CarrieLutz.com and sign up for 30 free micro trainings on financial survival.
1490 WGCH. This is Carrie Lutz, and you're listening to the Financial Survival Network, which is brought to you by Miles Franklin. They've been in business selling gold and silver for over 20 years, and I'm a customer because when you buy, they ship. For more information, find them on the web at milesfranklin.com or give them a call at 800-822-8080 and get a free quote. Trying to figure out what's going on with the precious metals today is no easy task. And that's why we decided to have Gary Wagner on to give us the upside of what's going on here. And Gary, welcome back.
Thank you, Kerry. Good morning. How are you today? Or I should say good afternoon there.
Hey, man, I'm about ready to have dinner, and you're just having breakfast. But
we're going on brunch time right now. That's correct.
Yeah, in case you don't know, Gary's in beautiful Hawaii, and when he's not in front of his screens, I think you'll find him on the beach in his Hawaiian shirt. Right, Gary?
Absolutely correct. And in front of my computer, I'm still in my Hawaiian shirt. No doubt. No doubt.
All right. So these patterns, though, they're much uglier than a Hawaiian shirt, aren't they?
You know what? It's an interesting time that we live in. There's no doubt about it. And I have been charting a triangle correction. And typically what you get on a triangle correction is where you get a succession of lower highs and higher lows. And as it comes to the apex or the point of the triangle, it will typically break and break very, very hard. And that's what you're seeing on the screen right now. When we take a look at this market as it stands, and what I put up is a daily chart, and what you can see is a very, very long-term trend line. I'm going to try to put that in for us traders. Hopefully this will show up. But we had a very, very long-term trend line, and this starts back in 2008. You take these bottoms here and you fix it to these lows here and project it up. As you can see, we had a real major break below that point. This is that break below. We were honestly expecting it to break to the upside. It, in fact, did not. And right now, we've got the metals under a lot of pressure. I think today we were down about $14, $15.92, and it had a low of $15.77, Kerry.
I know. I've been watching it and trying not to take it all too seriously because watching the tape, if you're not a trader, is pretty much a recipe for losing your mind.
Well, you know what? Even if you are a trader, the way that we've seen these markets move lately ages all of us a little bit quicker, I think.
Yeah, well, being that I'm going to be 55 this summer, I don't want to age any faster than I absolutely have to. So I think I'll let you watch the tape.
Well, you know what? I'll be 57 this year, so I think we're in the prime of our lives.
I feel like it, definitely. No question. Because managed to hold on to a couple of bucks during the years, managed to hold on to my sanity. Kids are doing well, and I'm doing what I love. And when you combine those things together, you know, if gold goes up or down $50 in a week, it's really not that big a deal because I don't think the long-term trend really is in any doubt whatsoever.
Well, you know, the long-term trend is absolutely being threatened here. But when we look at the big picture, as we just did, I think you're correct. In the long term, we absolutely see real solid support above 1,500. 16 was a psychological target. It has breached that. That had been holding. But if you consider the kinds of moves that we've seen, in other words, we have seen gold move since, 2008 from about 750 to a high of 1920. This kind of correction is still a correction in a bull market, no doubt.
Absolutely. And that's what you have to keep track of, is that these types of corrections occur to shake out the weak holders. And I can't believe that anybody holding the metal at this point is weak and would even consider going to the coin shop or the bullion dealer and trading it for dollars that just are escalating at a rate that we never even imagined was possible several years ago.
Absolutely. For your listeners that are investors in physical bullion coins, yeah, you absolutely want to hold on. You want to look to see where we get some significant support as a really strong potential to add to your portfolio. You want to add on weakness and you want to sell on strength.
Absolutely. Couldn't have said it better. So we're looking at these triangles, and we were all anticipating this triangle to come to a peak probably around the end of June. Here we are. It broke it in May. From a technical standpoint, what does that usually mean?
Well, when we take a look at how this market broke, and what we're looking at here, I've just kind of blown it up on the screen. This is our weekly chart, and this is of June gold right now. And we had really two real critical areas that we were looking at in terms of price point. And the first one is what's known as a Fibonacci retracement. And a Fibonacci retracement is simply a sequence in which we look for the market to backtrack on an upward slope. In other words, if a stock moves from $1 to $2, it will typically come down like a stair step before moving back up. The percentage it comes down is a very highly watched number. And in gold, as you can see, when we take a look at the beginning of our rally, this is at 722. This is October of 2008. We take it to the top, which is 1920. And then we say 23% of that move is our first level of retracement. And then we'll go down to in the 30s, and then a 50, and then a 61%. But that number was 1639. You can see that that's the high or the beginning of the trading week. So it not only broke through that, but it also broke through this long-term trend line. Now, what does that mean? Does that mean that the bull market's over? No. But what it could be significant of is that we're in an extended correction, that this correction is certainly not over. And once it does cease, we'll return to a normal bull market. That's my opinion.
Mm-hmm. So if you're a nervous Nilly, if you're anxious, if you're sweating over this, how do you handle this? What's your advice to the nervous trader, which if I was trading, that would be me?
Well, you know what? In terms of trading, you can go long or short, and you control your risks. You define them, whether you're trading options or you're trading futures with stops. If you are a physical purchaser of the metal, it's really a whole different story, because you don't want to look at what I call the day-to-day noise, that activity, and you want to be strategic enough about it to realize, if you were to sell your precious metal, what would you buy? And just as you said, you'd convert them into dollars. And that's really something that is different in the marketplace than we have seen over the last, say, 6 or 8 months. And what I'm talking about is when gold is traded, it was typically traded as what's called a safe haven asset. In other words, this is what you have for security if there is uncertainty in the world. There's been a dynamic shift in that. In this last move, we had the elections over in Europe. There's great uncertainty. We had triple-digit falls in the equities markets globally. And rather than going into gold, they went into gold a little bit, but primarily into the dollar and treasuries. And that, to me, is what is really perplexing, because this is the dollar chart, and you can see it's been moving pretty much straight up since the beginning of May. But when you consider where are your assets, where do they contain more safety, to me, it's still got to be the precious metals. The dollar itself is vibrant and strong, and that's where they're putting the money. But I think that the precious metals is really the significant place you want to put it at long term.
Yeah, it makes a lot of sense. And we see the banks in Europe imploding. Spain just bailed out their number 3 bank, and there's going to be more of the same of that. So that would explain a lot about the dollar's perceived strength or less than perceived weakness against the euro. And there's this fear sweeping the world that the euro is going to cease to be an entity or exist. And then what? Then we've got 25 new currencies to be figuring out what they're worth against every other currency. And there's problems ahead.
Yeah, there's no doubt there's problems ahead. You mentioned Spain, for example, and when you consider the fact that they've got 25% unemployment, they really are in a quandary right now because you can only cut so much out of a budget to make ends meet, so to speak. And the entitlement programs that they're stricken with, and you've got the same scenario happening in Greece, they don't have the kind of dynamic economy that's needed to really kickstart and get themselves going and moving to the other side, meaning moving into a profitable budget. And just by cutting, that's not the answer. The answer is they've got to retool their economy in such a way that it has some power behind it and it shows profit like any company. And the issue to me isn't so much the austerity, because I think that it's needed. It's they need to do something besides that austerity. They need to retool their GDP so that it matches, or is balanced, I should say, to their expenditures. And that's the real issue.
Yeah, well, when you have the government intervening in every market, in every country, it's going to bring about malinvestment. And they had an amazing amount of it because they were on the euro. Their interest rates never really matched the risk involved in the economy. And now the bubbles burst and they're broke and they don't know what to do to get out of their own way, short of liquidating the country. In Spain, you had the malinvestment in real estate. I remember being there 4 or 5 years ago, and it was like being in Beijing. Cranes as far as the human eye could see. And all of these condos, and it's like Las Vegas. They had this Las Vegas mentality. If you build it, they'll come. And
right.
They might come, but they're not necessarily going to stay. And they surely aren't going to buy when prices are too high because of the malinvestment. And if you don't allow institutions to fail, if you don't purge the system of the excess debt, then it's just like the United States during the Great Depression. They never allowed the healing properties of debt liquidation to be felt by the economy. Instead, they inflated in an effort to get out, and they never did get out of the Depression until World War II started, and that effectively put people back to work. You could argue whether it created wealth or not, but certainly it ended large-scale unemployment. And they're not allowing it to happen this time either in any country in the world, especially in the European continent. But you're seeing it in China as well. Malinvestment, cities, ghost cities, bridges to nowhere, bullet trains to nowhere. And we just don't learn from this stuff. And then when you try to stop it, you prolong the agony. And that's what that chart's showing us now, because perhaps it'll be the opposite of what we expect. These currency collapses will be deflationary in nature because the extra units, they'll just stop producing them. They won't be allowed to for some reason that we can't perceive from these charts. But these charts could be telling us that there will be massive currency deflation around the world, and that gold, while not going up in monetary units, will effectively go up in purchasing power. Whether there's inflationary collapse or deflationary collapse, either way, the precious metals always wind up gaining purchasing power, right?
With the precious metals, the way I look at specifically gold, somewhat silver, is that their real value really hasn't intrinsically changed over the last 100 years. It's the currencies that they're paired to that are the markets that are really drastically changing. So when you say purchasing power, gold really has the same purchasing power it had in the 1800s. if you took an ounce of gold, for example, back then in the 1800s, which was a $20 gold piece, and you went into a town for $20, you could buy a new suit, have a great dinner, stay in a nice hotel, all of that for that one $20 gold piece. Today, if you take a $20 gold piece, or let's just say an ounce of gold, not the numismatic value, it's still worth almost $1,600. You can go into almost any city with $1,600, buy a good meal, get a suit, and have a place to stay for the night. So over time, it's not so much that the metals have changed, it's as these currencies become devalued and their buying power goes down, that gold stays steady and stays the same.
Absolutely. And the time when the purchasing power goes up is when the companies, the businesses, and the economy have to liquidate their inventories at low prices. And that's what leads to a temporary increase in purchasing power. You saw it during the Great Depression. And when back then, when supposedly the dollar was as good as gold, you would have to get change of $100 bill at certain banks. You couldn't get it in many places. You couldn't get it in a supermarket because a bag of groceries cost $2, and you went in there, you gave them the 100. They didn't have the money to cash your check, to cash that 100. And I don't know, this chart, I never believed that it was possible that we could go deflationary, where the Fed and the ECB and all the other world central banks would allow their currencies to effectively implode and collapse and wind up a dollar being worth, or put it this way, an ounce of gold being worth $50, but having the purchasing power. But looking at this chart, I've been a deflationary skeptic all along. I still am, but that chart kind of points to me to deflation. Whether I'm right or wrong, I don't know the answer to that. I don't think anybody does. But right, weren't you a deflationary skeptic? Did you believe that it would be possible to drive up the value of the currency, whether it was deliberate or accidental? Did you ever believe that could be possible?
Not to any great degree. No, it doesn't theoretically make sense.
I know, and that's what so many of us are expecting: inflation and loss of purchasing power. And yet, maybe there's another side here we haven't considered, but this is all speculation. Just like I have a theory, Gary, while we know the emerging world central banks are certainly stocking up on gold, it's no secret the Chinese, the Indians, the Thais, the Mexican government is doing it. I have a theory that the developed banks, the developed central banks, meaning the Fed and the ECB and the Bank of England, are also accumulating gold on the sly. Do I have any proof for this whatsoever, other than a nagging suspicion that these guys might be extremely devious and some would argue evil, but one thing they're not is stupid, right?
Absolutely. Well, no. One thing they are is very, very smart. You're absolutely correct on that. But there's one thing that we do need to note when we compare the United States to the EU or any of these other large powerhouses, and that is that the United States still has the most dynamic economy in the world. We're the only ones that have an Apple or a Google.
Yeah.
We are still the leaders in innovation. And this is why I believe that they're flocking to the dollar and flocking to treasuries as opposed to gold right now, because the belief is that, and I have to believe this holds some merit, stimulus, meaning quantitative easing, in any other country besides the United States is a recipe for slow destruction.
Yeah.
They don't have the GDP to be able to ever pay it back. So you're taking loans that you can't pay out. And so that kind of debt restructuring isn't going to work. The United States has the kind of vibrant economy where stimulus actually, if it's ever going to work, and I don't really believe that that's the best way to jumpstart an economy, but if it's going to work anywhere, this is where it would work.
Yeah, I kind of agree with you there, but I think it's unsound economic Keynesian policy that's been disproven over the years, and maybe the U.S. at some point had an economy that could withstand the damage that stimulus inflicts. But I don't know about now. But the other issue here is energy. And what you see here is the U.S., and if you were into Lao Tzu, you would say the U.S. was underplaying its energy hand. The energy revolution that's taking place in this country now, very few people really get the significance of it. The fact that Dow Chemical is building a huge new petrochemical plant to take advantage of fracked gas, selling at $2, 1,000 BTU is huge, and people don't really understand that. So that's kind of the other opposite end, that no matter how much damage the government does via these programs, which really don't work in the final analysis. I think everyone agrees on that, except your most addicted Keynesian who is, got DTs because he just can't accept it doesn't work.
Right.
But, everyone knows stimulus doesn't work. And yet we see an energy economy emerging in the U.S., extractive industries that no matter what the government's tried to do, they couldn't destroy that industry yet. I mean, they're talking about fracking damage, but you know what? The frackers have now come up with a water-free method of fracking the rock called propane gel. So they don't have to use the water. So what are they going to come up with next to try to shut them down in this Ayn Rand kind of going Galt economy, the way it looked? But in any event, these are trends really longer term going to play themselves out down the road. My feeling is deflation probably unlikely in light of the central bank's reckless nature, but we're just going to have to see. Anyway, Gary, people want to find you, learn more about your system there. Where do they go?
They go to thegoldforecast.com. It's one word. And I do offer a daily video newsletter and an email newsletter, and your subscribers are free to go on and try the free trial subscription.
All right, great. And I get the videos every day, and I watch as many as I can. And if you want to see more interviews that Gary and I have had or listen to them, just go to financialsurvivalnetwork.com. I think we've got a link to Gary's site there as well. And you can go back and track Gary's trading path. All right, Gary.
Absolutely.
Hey,
pleasure as always speaking with you.
Hey, you too. And we will talk to you again soon.